Good afternoon, good morning, good evening, depending on what part of the world you're in. But I'll just say good day. This is Arlan Suderman, Chief Commodities Economist with StoneX, and I'm so glad to be back with you. It's been a little bit of a hectic day. I almost didn't make it here, but I did, and I'm happy to be with you today for this webinar. I need to get this slide up here. This was one of the reasons I'm late right here is compliance changing the slide on me. And so I want to give you enough time to take a look at it and read it. And compliance wasn't the only reason that I struggled to get it. There were other things too, so I don't want to put it all on them. It was just one of the factors. When everything kind of goes wrong, they all go wrong. But anyway, hopefully you've had the opportunity to take a look at that slide. We can talk about this report that had some surprises in it today. First, let's talk about the money aspects of the price discovery process. Price is a function of supply and demand is modified by the flow of money. So we start off both by looking at the Federal Reserve monetary policy, and they continue to keep their pause on the interest rates at their meeting last week. And it was ironic that in this meeting, they listed all the reasons why they plan on cutting rates, and those are the reasons they said they could not cut rates back in December. So clearly there is some political pressure or something being applied to the Federal Reserve, in my opinion, that has got them convinced that they need to cut a rate. You can say maybe we've been above the 2% mandate for 3 years now. Maybe they've given up on it, but just don't want to say that. I don't know. But we have a vigorous economy. The GDP numbers out this morning certainly indicated that as well. Doesn't say every aspect of the economy is vigorous. We know the manufacturing certainly is not, but the economy as a whole is. So as we look at the consumer price index, it's really stalled out since they quit raising rates. Kind of makes you wonder, did they did they quit raising rates maybe 1 or 2 too soon? We're still below the long-term average by nearly 0.5%. Now, it depends on which average you use. So 1 to 2 increases, would get us up to the long-term average. So we're below that. And people are complaining about these high rates. So I guess it's relative. I've certainly seen higher in my life. Many of you have as well. But if you're younger, you haven't. So it's all in perspective. But the inflation has become rather sticky trying to get down that final percentage point. And I've talked before about personal consumption expenditures for durable goods. This is adjusted for inflation, and you see that we're following a higher path of demand now for durable goods than we did before the pandemic. And that is illustrative of part of our problem. Is the consumer is addicted to spending even if they have to build up credit card debt to do it. And that keeps demand going. That keeps jobs flowing. That keeps wages up. We have a shortage of housing in this country. All of it coming together to create problems for the Fed if it cuts rates. And lo and behold, it said it's going to cut rates. Now, the story, the dot plot was the median stayed the same, 3 rate cuts this year. But if you look at the average of all the dots, it said 2 rate cuts this year. And right now I'm going with they're going to make that 1 rate cut because they've decided to do it probably at the June meeting, and there may not be any more rate cuts. We'll see how it plays out. I've talked before about government debt servicing and how much interest costs are just starting to skyrocket and going to continue higher, putting upward pressure on those interest rates as we go forward. It's interesting, earlier this week, we had the Consumer Confidence Index data come out, and that survey found that more than half of consumers surveyed believe that interest rates are going to be going up this year. Who's buying those debt certificates right now? Banks have been buying a lot of them, but they're running out of cash. Over the next couple of months, we anticipate that that surplus cash that's been sloshing around is going to start drying up, removing that as one of our demand for debt certificates. You see here kind of who the buyers and the non-buyers are, and you can see They're the decline in Federal Reserve buying. So we've got to replace that buying with someone. Foreign interests are declining in their purchasing as well. So households are the ones who are increasing right now. Will they do that if they see inflation going up? Will they continue to do so? When we look at inflation expectations, our 5-year break-even inflation index, which is the goldenrod colored line there, is ticking higher. Will it break out to the upside? The 2-year is starting to look like that. The 1-year certainly is starting to look like that. It looks like my circle got moved over somehow in loading up this file into here, but the circle should simply be over about a ½ inch. They're kind of circling the right-hand side of that screen in those lines. Let's see the strong correlation of 0.87 with our commodity tracker and the value of our commodities, how closely they track together with when the market believes inflation is starting to go higher, then historically, the funds want to be long rather than short. And they've been very short the grain and oilseed complex for quite some time. Excuse me. And you can see this played out just looking at the index fund ownership of the ag sector overall versus the Fed funds rate. If you look at total managed money position as a percent of open interest, you can see that managed money is very dominant in the wheat complex right now, and becoming more so in the corn as well. Now, if we look at that StoneX commodity index we're talking about, which would be the blue line here, versus the CPI, our inflation measure, our consumer price index, correlation even stronger at 0.89. When you put the grain and oilseed subtracker versus, we see a 0.87, so essentially the same thing. Now, if we look at here, I have the 1 and 2 year expectations of inflation, see how they've been trending higher since that December meeting when the market had interpreted the Fed as pivoting. And then the Fed, I thought, would try to go more hawkish to try to undo this at the last meeting. Instead, they went more dovish in their comments. If we look at geopolitical risk, one substantial difference this time from when we were last together is Russia has just changed the wording of how they talk about the conflict in Ukraine. They kept calling it a special military operation for the first 2 years of the war. And last week, they started calling it a war. They actually call it a war. And that has significant implications. That gives them more freedom to conscript more people into service, more troops into service, more public support is what their hope probably is for financing the war, dedicating themselves to the sacrifice of a war. All of this because Ukraine has been displaying greater capacity to attack Russia, sending missiles, drones deep into Russia, well past Moscow to hit oil refineries. And they have dramatically reduced, maybe that's a dramatic term, significantly reduced refinery capacity. It's hard to really nail down by how much. The latest estimate I saw was around 800,000 barrels per day. I've seen estimates as high as 1.3 million barrels per day of refining capacity lost, some of it temporary, some of it permanent. So that's had a big impact on Russia, and they're getting kind of ticked off, if I may say so. At least President Putin seems to be. So he has really escalated the attacks on Ukrainian infrastructure for energy and for exports. Now, the question still is, both sides have the capacity, the capability to sink ships moving through that region, through the Black Sea, the Sea of Azov. Neither side has wanted to do that to this point. The Houthi rebels are doing it in the Red Sea, but neither Ukraine nor Russia has wanted to do that at this point because how that might affect world public opinion. At what point does one of them become desperate enough to do so? The odds are probably still well below 50%, but the more this escalates, the more that risk continues to grow. So it's a black swan event we cannot discount. For now, we're seeing good export flow out of both Russia and Ukraine. Now, Russia has said they're going to voluntarily cut oil exports. Are they doing that to help support the price? Yeah, probably. Are they doing that because some of their capacity has been destroyed? Maybe so. We don't really know. The bottom line is that's certainly not bearish for crude oil prices right now, the way the market is interpreting it. That interpretation may change if they can't refine it and they're able to export it. But the sanctions of the West are really starting to have a more greater effect. That even China was bringing in less crude oil because of fears over the sanctions. So something to keep our eyes on. Now, as we look at exports coming to Ukraine, showing we're getting back to almost pre-war levels of exports out of Ukraine. Now, having said that, since Russia has stepped up its attacks on Odessa export infrastructure, I think the March numbers, when they come out, are going to be down by maybe 1.25, 1.5 to maybe as much as 2 million metric tons. So I do expect that to have an impact. Right now, I'm going to go with 1.5 million metric ton reduction in March for Ukraine. They've got outside foreign money coming in to rebuild, but it's still, if Russia continues to attack, we'll see what kind of effect that they can have there. China continues to be a potential black swan event related to Taiwan, but also I need to point this out, some data that we've seen. And this we'll come back to this when we talk about the straight fundamentals for soybeans. October to February is our prime export season. And historically, Brazil has owned the rest of the year. Well, now Brazil is shipping year round because of the growth in their production and their cheap currency. And so if we look at the October to February period this year, Chinese imports of U.S. soybeans were down by 10 million metric tons during that time period. And Chinese imports of Brazilian soybeans were up 12 million metric tons. Think we're losing market share? You bet we are. Cost remains a factor, impacted by currency. And also, you can't deny the geopolitical aspects of it as well. Excuse me. Now, Middle East risks are still escalating. There continues to be talk of ceasefires, and they continue to fall apart. But the Houthi rebels continue to strike at ships. Periodically, one will sink. Cargo ships moving through the Red Sea are down dramatically at a time when the Panama Canal is very limited as well. And so costs for shipping are going up, and that too is impacting inflation expectations. Here we see that this goes back to August when Panama Canal traffic was already down. And you can see that as Suez Canal traffic has dropped, we've seen the traffic going around the Cape of Good Hope and southern end of Africa go up, the relationship between the two there. Let's spend a little time talking about the weather. This takes a look at temperature rankings by climate district since January 1. Note how it was basically the warmest winter on record of the last 132 years, excuse me, in the Great Lakes, New England, and stretching to the west into the eastern Dakotas. So very mild for the winter. Doesn't mean it was warm, it just wasn't as cold as normal. Precipitation, well, that was down as well, especially in parts of Wisconsin, Minnesota, and the Dakotas. One of the driest winters on record up there. We've seen some improvement of late, but still very dry. Now, when we look at soil moisture profiles, not in real terms, but as a percentile of normal, we see that on January 1, the graphic on the left, the Midwest and really the whole Mississippi River Valley was in trouble. We still have some dry soils in the Midwest, but things have gotten better and continue to get better. I need to say that here over the last few weeks, The weather models have done very well on forecasting rains in the south, but the rains have come in under what was forecast by the models for the Midwest. So the models have underperformed relative to what we got in the Midwest. And that's not a direction that we like to go. If we look at the ENSO cycle, we were in an El Nino. We're still technically in an El Nino, but it's dying. And a lot of the models are calling for us to go into a La Nina by this summer. So what I did here is I put and this graphic actually comes from the Australian Bureau of Meteorology. If you look at the forecast models for where we're going to be at in July in the ENSO cycle, you see that Australian Bureau of Meteorology has us right here in a neutral to warm environment. Whereas the CANSIPS, Canada, has us into a weak to moderate La Nina, as does NOAA, as does the UK model. So you can see how the models differ dramatically. And I saw this graphic and I thought this really says well what I was been trying to tell you in recent webinars, that the models are all over the place and where we're going to be in the ENSO cycle in July. Which one of them is right? Well, stay tuned. We'll tell you later this year which one of them's right. You know, one of them might have a good track record for the past 6 months, but may end up with a weak track record for the next 6 months. We don't know. But what I want to say is, and I'm going to break this down more in the future in the slides yet to come, there's a lot yet to be determined that is an unknown, and I'll try to outline some of those variables and the implications of that. So, first of all, this graphic here, notice how we're still looking at warm waters here in the equatorial Pacific. But you can see they're starting to cool. Right there, you see some cool. Now, this is as of the 3rd of March. So if I were to update this today, there'd be a little bigger, cooler pocket here that I wanted to use this graphic. If you look, I also want to point out two other things, and that's this cool water up here in the Gulf of Alaska, stretching down into this area here, and then this cool water between Hawaii and the Baja of California. Those two areas are key. Because if you come over here to the left, Eric Snodgrass made this graphic back early in March. Look on the left, we have sea surface temperatures for 4 of our bigger Midwest droughts, 88, 91, 2002, and of course, 2012. Note that in each of them, we had cool waters here in the Gulf of Alaska in this area between Hawaii and the Baja of California. Each of them, we had a dying El Nino. In 88, we had already gone by July into a pretty solid La Nina. So that too was working against us. In 91, 2002, and 2012, we still had warm waters in the equatorial Pacific, but the waters were cool in the Gulf of Alaska in that area stretching from Alaska to the Baja of California. That is one of the key indicators of whether we get high pressure set up over the Midwest. So we're going to keep our eyes on that. That area is cool now. The models say they're going to warm, but the models this time of year projecting into July are very unpredictable, very low confidence. So I just want to be straight with you on that. That's something we're keeping an eye on. Now let's play it out a little bit more. If we look at the European ensemble forecast members, and I'm sorry, this is the composite of the what do I want to say? Analog years. I'm sorry. This is not the European. Strike that. This is the composite map of, you take those years that are outlined there, similar years, what kind of April did we have? Excuse me. And you can see that it was very mild, continued to be very mild overall in the northern plains and much of the Midwest, well, a little bit on the cool side in the central and southern plains. Stormy weather in the Midwest and in the South. Okay. Now let's look at it a little differently. Now let's look at the European model ensembles. Many, many different runs to the models with little differences and tweaks in them. So we break them into groups. This group on the left, representing 42% of those runs, pretty mild April and pretty wet. In fact, almost too wet for April. That's the predominant one. Now let's look at the middle set, 32%, 1 in 3 odds. Pretty mild Midwest. That blue shading there is almost undetectable. Pretty good rains across the Midwest, probably enough open windows to get early planting done. 26, or about 1 in 4 of them, of the runs, were pretty hot for April, pretty warm, with a mixture of drier in the east, wetter in the west, but no real significant problems. That's April. So the bias is pretty normal to above normal temperatures and moisture to help refill those soil profiles. Now, let's look at the European ensembles for summer forecasts. 52% warm, but pretty near normal precipitation. Those browns and greens there aren't that much further from normal across the Midwest. 34%, just a tinge on the warm side, a tinge on the dry side in the eastern Midwest, but pretty good rain elsewhere, especially in the western Midwest. Notice that we're dealing with cool waters or La Niña in both of those cases. 10% odds that we see a heat dome set up over the Great Lakes. Decent moisture across the Midwest, but a few dry spots, and again, cool in the equatorial Pacific. 4% odds that the heat really starts to build in the western Midwest, and we really start to bake the soils across the northwestern 2/3 of the Midwest, and we're in an all-out La Niña in the equatorial Pacific. But that's 4% odds. That's the European ensembles. Now, if we look at NOAA's multi-model ensemble, which takes a statistical analysis of a bunch of different models, you can see it starts off April, May, June up here, pretty wet across the Midwest and stormy. That continues in May, June, July, but we start seeing drought work its way up through the southern plains, which increases in July, June, July, and August. And then as we get in July, August, September, the drought really starts to spread into the Midwest, taking a deep hold in August, September, and October as we finish out the season into the fall, but with a very active hurricane pattern. If we look at the European model and break it down for the summer months, this starts with the April, May, June. Pretty stormy across the Midwest with drought starting to take a hold in the southern plains. If we then go to June, July, August, still pretty wet across the Midwest, but we're starting to see that drought start to take a little bit more of a hold in parts of the Midwest. Let me go back here. Yeah, start to take a little bit more of a hold. Then as we get in July, August, and September, these graphics, I'm sorry, the bottom line, look at the right-hand graphic. The left isn't really changing that much, but it really shows the progression toward the Midwest drought really taking a hold as we go through deeper into the summer months. What about Brazil? Well, Commodity Weather Group is saying that two of the similar years to this year, 2012 and 2016, through about the first 2 or 3 weeks of March. And then we had some rains in those years. And then 2016 turned off dry, and 2012 stayed wet right on through April. So the forecast models say we're going more the 2016 route. You see the 10-day outlook here showing rains coming back into Argentina next week after they've been dry, and we're still seeing above normal rainfall across much of the winter corn belt that I have circled in red there. What happens beyond that? Does it stay wet like that? The longer term models keep showing a dry April. Will this lock in or will it go dry? In 2016, if we repeat that, you could be looking at 15 to 20 million metric ton decline in production, because April is pollination early grain fill time. If we stay like this, like it did to 2012, we could be looking at above trend yields and be looking at a 5 to 10 million metric ton increase in production from where we're currently at. We'll know a lot over the next few weeks, and that'll have an implications for the market. If we look at rainfall, and again, this data is as of March 18, but notice that typical rainfall in Mato Grosso in March, is here at about 8.5, let's say, inches of rain. But in April, it drops off to about 3 inches of rain. Now, their soils are very porous, so they need more than we do in the Midwest. So the models are saying below normal rainfall, maybe just an inch or two of rain during the month. So that could stress the crop. If it happens, that's going to be the key question. Does it happen? And now, as we look at the fundamentals of supply and demand, we get the report data that came out today. Basically, not much of a story here in the stocks report. Corn came in 80 million bushels less than expected. So I have cut my feed usage estimate by a portion of that, because USDA doesn't put all of that into the balance sheet now. They want to see what the June 30th quarterly stocks report says. So I increased my feed usage by about 25 million bushels based on that. I cut my wheat feeding by about 20 million bushels. I reduced residual use of soybeans by about 14 million bushels. And that really accounts for the stocks report right now. And you can see here where the stocks are versus a year ago. And you can see most places have more corn in the bin now than they did a year ago. So that's why we weren't up the limit today. We saw short covering today and spreading of corn against soybeans that appeared, but there wasn't panic, get out the door type of short covering. Excuse me. Soybean stocks, again, generally higher in most of our key states versus a year ago levels. If we look at wheat stocks, different story there. Spring wheat territory, we saw increased stocks over a year ago. Hard red winter, it was mixed. Soft red winter, generally a little bit higher than a year ago levels. Let's look at acreage now. This is where the surprises were. Excuse me. Right here is the big one. Here is another one. So let's look at this. And I think you could even say here's another one, because this number really is just a little bit of a downgrade from where the USDA's December survey was at. So USDA lost a bunch of acres from their December survey of winter wheat acres. Let's break this down a little bit more. This is a map showing where we lost corn acres according to USDA. Now, if you combine corn and soybean acres, it comes to 176 some million acres, down about 2 million, think about 2.1 million from last year. Okay, that's notable. Why would that happen at a time when corn and soybeans are competing very well? Then when you look at corn, soybeans, wheat, cotton, we're basically down about 4 million acres. Grain sorghum, that's the other one. When you throw all principal crops in, we're down about 6.3 million acres. Where did those acres go? Kansas alone, that's where I'm from, the wheat state of Kansas that now grows, that's the fifth largest producer of corn, it lost almost 1 million acres. It lost in virtually every major crop. I'm not sure where that went, but these are the numbers we have from USDA, and this is what will be traded. So we better pay attention to it. Look at the corn acreage here of Minnesota losing 700,000 acres, Iowa 300,000, Illinois 300,000, Wisconsin 200,000, Indiana, 350,000, Ohio, 300,000, Missouri, 350,000, and it goes on and on. Almost every place loses corn acres. Let's look at grain sorghum. Oh, we lost acres here too. We were expecting an increase. That's the feedback we were getting. But look at Kansas down 250,000 acres, Oklahoma down 110,000 acres, Texas down 500,000 acres. Wow, that's pretty significant drop in acreage when corn is down as well. So let's look at soybeans. Well, there generally everybody went up. Kansas again went down. But look at Minnesota up 150,000, North Dakota up 700,000. If you look, and I'm going to show you a graphic later where we're building new crush facilities, that explains why we're increasing soybean acres. So that one's a little bit easier to understand because the bigger increases came in a lot of cases from where we're building new crush facilities. Winter wheat, total wheat acreage changes. You can see 300,000, increase in Minnesota. We had really anticipated spring acres, wheat acres being down this year. So that was a big surprise to see the increase. Total wheat acres, though, Kansas down 400,000, Texas down 500,000. Virtually everybody, almost everybody down, although big increases in Montana. And cotton acreage. Cotton acreage generally seeing big increases in the Delta and the Mid-South. So it's looking at consumption now. When we look at marketing year-to-date ethanol use for corn, it exceeds the seasonal pace needed to hit USDA's target by 95 million bushels. 95 million. So I do expect USDA to raise their ethanol estimate. They could also increase exports and feed usage. I don't know if they're going to do that yet in this report. Export shipments exceed the seasonal pace needed at USDA's target by 37 million bushels. Folks, cheap prices create demand. We're certainly seeing that. Now, that demand is certainly not going to China, as you see there. Not at all. If you look here at monthly imports of China by country, you can see that Brazil and Ukraine get the lion's share of it, especially Brazil over the last 6 months. And then you look at who's buying our corn, Mexico. Great customer Mexico is. And by the way, I read the article this morning that they're pushing back their objective of one would say banning GMO corn production because they just don't have the substitutes and they got too many hogs they got to feed, in addition to other meat protein sources. If you look at the supply side, this is showing yields in major producing areas of the world. Look how the U.S. dominates on yield technology, but other countries are starting to adopt that technology. In fact, China is really pushing GMO production. Having said that, thus far, it only accounts for like 2.5% of overall production. Okay, now the bottom line, because that's what really matters to the bottom line, right? How does this play into ending stocks? First, I have a lower ending stocks for this year because my export number is bigger, my fuel for ethanol is bigger, and my feed estimate is bigger than USDA. So ending stocks at 2.032 billion bushels translates into the beginning stocks of the next column. There's production at 14.9 billion, total supply at 16.9 billion. That'll push close to 17 now. You can see I've made modest increases in feed usage, other domestic, as well as ethanol and other domestic demand. So that helps put together the demand picture. I've circled these export numbers because they're down about 150 million from where USDA currently is on old crop. Those numbers could go up or down by several hundred million bushels yet. That's a huge swing possibility depending on how the winter corn crop matures here over the next 6 to 8 weeks, and especially the next 3 weeks. That's going to be critical. I then put in USDA's acreage numbers and typical abandonment, and I took USDA's trend yield times 0.95. Why 0.95? Because that's saying, what if we get adverse weather that reduces yield by 5%? That produces ending stocks at 10.1% stocks to use ratio, which does start to get traders worried, especially if the winter corn crop runs short in Brazil. Then that would leave us without much buffer. That would be a problem. And right now that's a concern, because if we end up with 5% above trend, all of a sudden we could end up closer to 2 billion bushels. If we look at soybean sales to China, they're doing better than corn, but they're doing the weakest they have in many years. In fact, this was a 5-year demand graphic that I was working on, and see how it's the lowest in the last 5 years. So China not buying our soybeans this year. They've bought about, year to date, they've bought about 7 million metric tons less than they did a year ago. And they're certainly taking a lot less for a quick ship. Instead, they're pulling from the reserve. This just kind of shows you something similar, or China flattening out their demand picture, and how they've been pulling from pulling from Brazil, and Brazil's really ramping up their exports at this point. And even as January and February here show a decline, because that's still old crop bushels that were shipped. It takes 45 days to get from the port to Chinese ports. So they've been depending upon some from the United States, but not near as much as typical in January and February. If you look comparison of those blue bars, and in fact, they've started pulling from their reserve supplies in order to reduce what they have to get imported on quick ship from the United States. If you look at shipments, this year's export target is below year-ago levels. And we're following pretty close to just above where we need to be marketing year-to-date in order to hit that target. So right now, we're about 14 million bushels above it. I think we're still going to fall behind it before the end of the year. If we look at crush, we're making up part of it there. Marketing year-to-date crush, about halfway through the marketing year, comes in about 18 million bushels below the seasonal pace we need to be at to hit USDA's target. Looking at sustainable aviation fuel, that industry continues to grow, demanding more and more soy oil. If you look at crush capacity correspondingly rising to meet that demand, you can see that our estimates have changed very little in that growth, because we've been conservative from the start. Here's where new crush facilities are being planted, and alongside those that already exist. And of course, the real concentration is here in Iowa. If we look at our soybean balance sheet, again, my export target is smaller than where USDA was for this last year. You can argue that, but that comes off my world balance sheet. And I will say, depending on what happens in Argentina this year and Brazil next year, you could significantly raise that supply by 300 million bushels in either direction. And if it's raised, then it lowers what China gets from us. If it's lower, then it increases what China gets from us. But overall, we see supplies working their way higher. Generally, as we look at wheat stocks, they too are growing, even in the different yield scenarios. We're increasing wheat stocks. All right. Now, so we look at fund positions. Note how they flipped last fall, and they've been short on top of us. We're building these supplies, and the funds are going short on the wheat positions. This looks at Chicago, Kansas City, Madoff in Europe, Minneapolis. Look at those short positions. They've been covering some of it, but what happens if something happens in the Black Sea to get them try and get out the door all at one time? That's a real concern when the Northern Hemisphere farmer is largely sold. Now, as we get closer to harvest, 4 to 6 weeks from now in the Southern Plains and in India and other parts of the world, then there's going to be wheat to go against the fund short covering. Right now, there really isn't. So here's my take-home points. Commodity deflation theme is losing influence. I've been talking about commodity deflation now for months, really since June of 2022. But that's starting to lose its influence. Geopolitical risks are rising, yes. We're also entering the time of year when weather risks in major producing areas of the world go up. So in the Southern Hemisphere, that's Brazil's winter corn. In the Northern Hemisphere, that's US Midwest. That's China. That's Europe. That's Black Sea. All those places, weather risks go up. Now, for now, the world is amply supplied with corn and soybeans. Even after today's report, the world is still amply supplied. Today's numbers, though, do remove some of the cushion from the corn outlook, while increasing the cushion somewhat for soybeans and wheat. Now, it doesn't increase the cushion enough to remove the weather risk. And that's my next point there. Weather risk still matters. Not as much for soybeans and wheat today as it did yesterday because of these numbers, but more for corn. And that's why we generally saw traders spreading corn against soybeans today. Now, I want to circle back again to that initial slide about money flow and say that the latest Federal Reserve statement that came out last week supports and increases my confidence of reinflation in the second or third quarter of this year, and putting more pressure on the funds to question whether they want to stay short the commodities. It doesn't say I'm bullish corn and soybeans, although a weather event could make me so, but it does say that the market historically has tended to balance supply and demand at higher price levels when reinflation is expected than when disinflation is expected. So with that, I'm going to wrap up my comments, take a drink of water, and allow Victoria to kind of read the questions back to me and try to answer as many questions as we can before we run out of time here today.
Thanks, Arlan. Yeah, we have a question here. With the second largest corn demand for this quarter, is it premature to ask if the yields were overstated in the January report?
Yeah, I think in corn we probably will. What we see is with USDA, when they have a shift like that in the second quarter, a lot of times they don't like to make a change until they see the third quarter numbers and see if it follows the same theme and how much of it is statistical survey error, et cetera. And I understand that because some of that's involved. But then they don't adjust yield until September when we get what's typically the September 30th quarterly report. And then they'll adjust the previous year's yield when everyone's focused on the current year, not the previous year. So that's their tendency. But yeah, I do agree with that. I do think that maybe their corn yield was a little bit too high, and that showed up. But I also do think that we increased feed usage because cheap corn has these feeders taking cattle and hogs to heavier weights this year because the margins are good. Appreciate that question, Kevin.
Another one we have here, Arlan. There was an article today about corn being dethroned as the top U.S. crop and being taken over by soybeans in the future as biodiesel productions ramp up. Do you foresee this taking place also?
To some extent, yes, I do. But I want to put it in perspective. For the last 15 years, we've tended to see very little shift in corn and soybean acres in the core of the Midwest, our major producing areas of the country, because the rotations work so well. And that's going to continue for a while. And even with today's numbers threatening that, I still think we're going to end up pulling back a little bit of that by the time we get to the June 30th acreage numbers, certainly by the final numbers next fall. It's those acres around the Midwest that we get our biggest changes. And especially as we build more soybean crush in the western Midwest, near the plains and into plains, then I think that takes away from some of the corn in that area. And that can include Nebraska, which is a core production state. That does tend to take away from corn in that area. And so I do think we'll see enough of that shift that soybean acres will overtake corn at some point. But I'm not looking for an immediate dramatic shift, because we're still also seeing a loss of export share to China. And for the near term, I think that's going to exceed the increase in domestic demand and kind of keep a lid on the shift to some extent.
Okay, the next one is 6.3 million acres reduction aggressive, or is it fair?
I think it's pretty aggressive, and I look for USDA to come up with different results in their June 30th survey, a June 1 survey released on June 30th. Or actually, I think that comes on a weekend, so maybe it's a little before that, like this one. Now, that said, I'm going to trade, so to speak, USDA's numbers. I don't actually trade, but I'm going to assume USDA's numbers for now until June. That's what I'm going to do, because that's what the market's going to trade, is USDA's numbers. It doesn't pay to fight USDA because the market's not going to, but I do expect an adjustment as we get into the June numbers, and then especially into the final numbers next fall.
Okay. Harry asked if you mean with commodity inflation and slowing down prices will stabilize.
Yeah, that goes back to my initial slide, and I'll bring it back up here. What an initial slide, to see if I can bring it up. And that's when inflation expectations are trending higher. History says that the funds prefer to be long the commodities in their portfolio versus short the commodities. And so it does, if we look at the data, which I don't have in the presentation of data, but it shows that we tend to manage supply and demand at a higher price level for the same fundamentals versus when we're in deflationary times. And so therefore, yeah, does that mean that I'm bullish prices? Not necessarily. It may simply mean that we don't go down as far. So it's a relative term. But it does have an impact all the way to the farm gate.
Another question from Harry. What is happening with China regarding U.S. milling dropping soybeans imports?
Well, I would say two things. A, they're worried about their dependency upon the West for imports. And the biggest part of that is the United States. But also Canada would be considered part of the West as well. We've certainly seen that in some trade disputes that they've had, particularly over canola imports. And so they want to be more dependent on themselves. And if they can't be independent on themselves, then do business with other BRICS nations. That's number one. Number two is they're very, very price conscious. And with the currency exchange rates being what they are, Brazil has been very competitive, generally competitive to $1 to $2 a bushel cheaper than U.S. soybeans coming from the Gulf. So those two reasons have been a major factors in their shift toward Brazil soybeans and also Argentina.
I think you covered all the questions we had for today, Arlan.
Okay, excellent. Well, before we close, I want to tell you, I'm double checking the date here, but April 11th we'll be back to with the USDA WASDE report. Well, we'll incorporate these stocks numbers, and we'll also give you an update on what's happening with weather in Brazil's winter corn growing areas as they go into pollination. and also update on what the weather models are saying for the U.S. Midwest for planting and for the summer. So be sure to come back for that in April. Look forward to seeing you then. Thank you very much for being here today.